Recording in progress.
All right, welcome everyone to tonight's Sunday macro wrap up for Sunday, December 14th. My name is Johnny Zerdy. Welcome everyone to tonight's wrap up. This will be the last macro wrap up for the year, and so we'll make it a good one. Don't worry, we got lots to talk about here from last week as well as some things coming up this week. Huge trend shift going on right now happening in the market, something that my team and I haven't seen really since like 2021. Yeah, I mean, in short, I don't know if anyone should be shorting this market right now, seeing the transition here. Um, we have not only confirmations from the bond market, but this was also echoed by the Fed. And really, we're just not seeing that. We're not seeing this show up in the real data because the data is very lagging from the government shutdown and everything like that. But from the leading data that we'll be getting into here in a second, we'll show that the markets are pretty much dialing up here for a pretty decent acceleration at the beginning, at least, of 2026. So that is quite exciting. A lot of the assets that we've been bullish on have been showing to gain strength and signaling that as well, such as silver and some of the other precious metals. So we'll get into some of the different assets as well. But for those of you that are new to the Sunday macro wrap up, and for those that are joining on our stream here, the way that these work is that the first 30 minutes of the hour is streamed on our social media pages. And then for the second 30 to 45 minutes, it's usually an hour long. Sometimes we go over. But the second half is all offline for just our Macro Optics members in our membership. So right now, we're still having a 6-week challenge for our Partnership Circle members. It's a free challenge where essentially you get access to all of our information, right? So all of our training modules, all of our insights on the research that we're producing for just our members, but also as well, all of the key ETF stocks that we're looking at, also crypto when it's bullish, as well as all the different selections. And so if you want to gain access to that and join our discussion offline, where we're going to do a Q&A and go over some of those actionable ideas, just go to the link in the description below or in my bio, and you can go ahead and book a time with me, and we can go into more details on what that looks like. But let's go ahead and get into this. I got my book ready to go here. For those of you that don't have one, get a small little notebook and have like a financial journal. It really helps you stay organized, and really the main reason why people fail in investing and trading is because they're disorganized. You'd be surprised how much of a leap your success rate goes when you're just organized. Not only every single day in your notebook, but also too in your different charting softwares. Like we use TradingView, but a lot of people can use other things. But organization is key before anything else. So, but we got our notebook here, so we'll go ahead and get right into it. And so the big thing last week was the FOMC press conference, right? The last Fed meeting of the year. Jerome Powell went on TV and basically had a complete 180 from the October meeting, where, if you guys remember, in the October meeting, there was a lot of signaling of stagflation, a lot of fearfulness on the labor market. Really, it was more of a doom and gloom type of thing. And during that time as well, that was like the first Fed meeting of the year where we didn't have any key macro data. And so it was pretty surprising. It was really unusual. And so it was kind of understandable on why they had, growth right here for 2026 at 1.8%. And so, with that, as well as core inflation remaining at 3.1%, a lot of the market was pricing in that stagflation. You saw gold go up, you saw silver skyrocket, which it's still doing. But with this new meeting that just happened last week, there's a complete flip on the growth narrative. So if we take a look at the new summary of economic projections from the Fed, they upgraded that 1.8% for 2026 to 2.3%, which that's a large, I know it's only, 50 basis points, but that's pretty large, okay? And the comments from Jerome Powell was, we're expecting a large acceleration in growth, and things look really great. and they're not worried at all about inflation. And so that was the big surprise. And, it wasn't really a surprise because we started to see this signal in the United States yield curve as well, which we'll get into here in a second on some of the leading indicators. But it was pretty interesting how Jerome Powell was like, yeah, the labor market is still weak. The unemployment rate, though, is still at historically low levels. And we think that we're just still normalizing in the labor market. But when it comes to growth and everything and inflation, we're not worried about it. We're pretty confident heading into next year. And so that that single day on Wednesday, it got the entire market up. But then on Friday, we had that little bit of a sell-off and spook from Oracle earnings as well as Broadcom earnings. And so there's a little bit of a rotation out of these large mega caps and into more cyclicals, industrials, financial sectors, small caps, value stocks, all those sorts of things. And again, we'll get into the charts here in a second, but that's kind of like an overall summary. But we also got some data on the job openings. Wasn't that, as important as the FOMC press conference as well as the AI earnings, but that's what we saw as well. It had a little bit of an improvement there. But what was interesting is that, the way that the Fed signaled what they're, going to expect for next year, really it's a regrowth from where we're at with disinflation. It's essentially a soft landing, right? And they've done this before as well, right? Coming out of the 1970s inflation and things like that. And what they're choosing to do is essentially inflate the debt away. And they are hoping that the productivity boom from artificial intelligence and all this capital investment that's going into AI is going to pay off, and the rate of productivity is going to outpace the rate of inflation, right? Because really, this is the same for households too. Like, let's say you have a lot of debt. The only way to get out of that is to either increase your income, go into more debt, or decrease your liabilities. Well, the government, they're not going to decrease liabilities, right? All they're going to try and do is essentially increase their income or increase their productivity. So that's the whole play for 2026. Now, the thing is that type of play is like picture perfect, right? Like nothing can go wrong. And so any type of hiccup in that narrative is obviously going to be, different headwinds with the market. And so that's what we saw here on the Fed meeting last week. And what was also interesting was you had some dissents on whether or not the Fed should cut rates or leave them where they're at. And so, you had a few dissents here, which was more than usual, right? Dissents are just people on the of the 12 board members on the FOMC, 3 out of the 12 said they wish that they all voted to pause instead of cut by 25 basis points, which really, that's pretty rare. I mean, typically you may only get one dissent, but typically all of them are usually on board. But this one we had 3. But, taking a look at some of the key comments from Jerome Powell on inflation, he really said that the inflation that we're seeing right now is 100% due to the Trump tariffs. None of it is due to anything else. In fact, he thinks that services as well as the major components of inflation that a lot of us care about, shelter as well, all of that is going to come down. And so he essentially said, we're going to get back to 2%. And people just care about their jobs. So as long as he can maintain the jobs market and this AI boom can happen, everything will be fine. And so, talking about inflation, we are going to get the November CPI this week, I believe on Thursday. Let me see. That'll be on, Thursday, the 18th. So we're going to see that there. But essentially the comments were that goods inflation from tariffs should peak in the first quarter, and then it would take another 9 months after that for all the tariffs, as long as there's no new tariffs put in place, for it to circulate throughout the economy, and then we can start to see general inflation come down to 2%. So that's a fancy way of saying that he thinks that the overall CPI is going to remain well above their 2% target for next year. So, it wouldn't be surprising if it's around anywhere between like that 2.8 to 2.6% next year. It'll be surprising if it maintains that 3%. That means the Fed got it wrong. But what Jerome Powell basically said was, as long as there's no new tariffs, that we should start to see a pretty decent chunk of inflation come down next year. And then, well, let's go ahead and just take a look at the current CPI report, right? So right now, at the timing of this video, the current CPI, headline CPI, is 3.0%, right? Headline CPI is a little bit less, I believe, at 2.8%. And then when you take a look at the largest components of inflation, this is what he's talking about here. So this is services, core services inflation, and you can't really see it because my head's in the way. But you can see right here that it's at 3.5%, and it's been trending down, right? And it's pretty close to, pre-pandemic levels, which is around, 3%, 2.8, 3%. So it's getting closer. So this is the largest component, and that's what Jerome Powell is referencing to when he says that, services inflation is coming down. Same with shelter, right? So shelter is another really big component. That is, near or getting closer to the pre-pandemic levels. Pre-pandemic levels was around, 3.2 to like 3.4. And right now we're at 3.6. So that's what he's referring to in terms of that type of inflation coming back into balance. So the two larger components. And then when we take a look at the two largest components of shelter CPI, we can see that owner's equivalent rent, which is, I know it's kind of a weird way to think about it, but this is essentially what homeowners would believe they would pay if they were to rent their own home, as a renter. I know it's kind of weird to think about it that way, but that's one of the major metrics, and that's also been coming down pretty substantially. Yeah, and so also as two, rent, that's pretty much near pre-pandemic levels. Now this is the rate of inflation, right? So this is essentially the acceleration component, right? When you take a look at cumulative inflation, so if I go back to the regular CPI number and just go to the index level, you can see how cumulative inflation has continued just trending higher. And a lot of people forget this when they think of inflation, but inflation is cumulative, meaning that ever since 2020, the total inflation from 2020 to 2025 is around 26%, right? But the rate at which it's accelerating is at 3% right now. And so when you see online or in the news that inflation is only 3%, that's the rate of change compared to the previous year, right? Like let's say, if we're looking at this graph here, this would be a car's speed, right? Just nominal speed. So it'd be like, in 2023, if this is like 60 miles an hour, well, right now we're at 80 miles an hour. And then the rate of inflation, which is what you see on the news, that is the rate at which you get from 60 miles per hour to 80 miles per hour. And that's what you see here, right? The rate of change. Cumulative, though, inflation's up 26%, which is pretty crazy for, how short of a span that is, only 5 years. That's way out of whack for what the Fed wants. And so they're just trying to get back to that 2%, but really it's like, if you're going at 50 miles an hour and then you accelerate to 80 really quickly, and then now you're just going to go up, very slightly and have an acceleration, you're still going faster. It's just you're going faster at a slower pace, right? So in other words, inflation is just going to keep going up. And so we have to protect ourselves and our capital by investing strategically. That's the whole point of learning about macroeconomics and learning how to invest. It's not just about making money in the markets. Of course, it's about that, but the reason for that is so that you can actually combat against these central banks and central planners that, even going back hundreds of years, the whole point of supporting this central structure is so that the public, us, you and me, we will not think about the silent tax, which is inflation, right? Because if it's just at 2%, nobody's complaining. But if it goes up faster than that, then people start to grumble. And so when Jerome Powell goes on TV or the government goes on TV and they're said, we're working on inflation, all they're trying to do is get it back to a level where nobody's noticing it anymore. But inflation's never going away. And so, yeah, it's our duty for ourselves and our family to learn how to make our dollars grow at either at the pace of inflation or faster, hopefully faster, so that you can maintain purchasing power. Otherwise, if you're just owning cash, you're going to fall behind. But when taking a look at some of the other components of CPI, when he talks about tariffs being the only issue, he's mainly looking at food and beverage has gone up a little bit, but it's still similar to where it was back in 2021 and slightly above where it's at in 2019. It has been accelerating though, pretty much since it bottomed out in August of 2024. But the real big concern is this one right here, which is durable goods, which normally, pre-pandemic, that was mostly negative a lot, right? And it did come down a lot, which was a pretty decent, it helped disinflation a lot, right? So we came from 9% inflation back in peak of, or June of 2022, down to where we're at right now. But ever since August of 2024, the durable goods cost index has gone up to positive. And this is the highest really that it's been from the negative level since post-pandemic. And a lot of it has been from tariffs. There's no doubt about it. But the big question is, with all the stimulus that's still going on fiscally, right? Because in the background during this entire time, you still have the government issuing bonds or issuing debt, short-term debt in order to fund the government, which is completely unsustainable. They're doing that because rates are higher. Why issue more long-term bills and hold, that longer-term debt at a higher rate? And so they're just, printing essentially short-term bills. The problem with that, though, is that you're continuously rolling over larger amounts, and so it's unsustainable in that way. And so the government is really hoping that rates will come down. But the thing is that it's kind of like a game of whack-a-mole where if you lower rates too fast, that will accelerate growth and inflation again. And so you can't have both ways. And so there's a delicate balance right now that the Fed is trying to play with so that those two things don't get out of whack. And of course, the tariffs are kind of a wrench in that. But yeah, so I mean, there is some validity to what Jerome Powell is saying, but when taking a look still at shelter inflation as well as services, even though it's still trending downward, it's not quite near pre-pandemic levels, especially with services, right? That's at 3.5. That's still well above 3% from the post-pandemic. And then if we go back way far, even 10 years ago, or let's just go from post 2008, whoops. You can see that it's still much higher than it is, pre-pandemic. So that's really what we need to pay attention to for this next year coming up, because if we continue to get disinflation, which a lot of the leading indicators are suggesting, as well as growth kind of remains steady and the labor market doesn't implode, then the Fed and the government have a pretty good probability of success with getting inflation back to a level where nobody notices it anymore. The only problem, though, is that because inflation is cumulative and we did have this large jump post-pandemic, I don't think it's ever going to go away. So, yeah, I mean, it's a huge mess. But again, the only way that you and I can combat this is by investing wisely. And so, yeah, getting into some of the other stuff here. Coming up this week, in terms of the macro data, it starts on Tuesday. There's really not too much tomorrow. I think there's Empire State Manufacturing Index, but that's like a medium-term one. Some of the bigger ones, we have core retail sales on Tuesday, non-farm payrolls finally for November. It's been so long since we've had that. All right, that's actually for ADP, I believe. And then we get the unemployment rate. Actually, no, that is non-farm payrolls for the actual BLS data. So yeah, that'll be pretty interesting there. We also get the unemployment rate for November. And then on Thursday, we get CPI for November. We haven't had that in a while. And then core PCE for October on Friday. So we get a bunch of inflation data as well as some labor market data. So this will definitely be a week where it's either confirming or denying the stage that Jerome Powell and the Fed just set last week. So pretty important data coming up here. Taking a look at the probability of the Fed cuts or the target rate probabilities for the January meeting. So this is the first Fed meeting of the year on January 26th. We can see that right now at the recording of this video, there's a 76 or 75.6% chance that they're going to remain paused where they're at and not cut by 25 basis points. So, that's not really a surprise because it was where they were going to pause in December and then cut in January, but they did it, 1 month early. But what you want to do is you want to take a look at the probabilities of a cuts from now until the remainder of the year next year. And right now, the futures market is only pricing in 2 cuts. One in the month of April on the meeting on April 29th, and then another one on the September 16th meeting. So that's not as much as what was previously had. I believe at one point a couple months ago, there was 4 cuts being priced in. So we'll see. I mean, they have the neutral rate around 3%, which is still a lot higher than the pre-pandemic, 0 level, as well as that's a lot higher. I'm not sure if you guys have seen how Trump is calling for a 1% inflation rate. And, you have to remember, even if Trump does get his guy in there, I think is Hassett or something like that. I forget his first name. But even if he's, got his guy in there, you still have 11 other members that you have to convince in order to vote your way and get a majority vote on the FOMC board, right? It's not just the Fed chair who makes the final decision. He's the person who gets up on TV and lies to people and tries to convey that he's for the people and not a legal cartel. But there's still some issues there. The people who work for the FOMC, by the way, they're probably doing their best, but the system that they work for is if you read about the Federal Reserve and how it was how it was brought up in a secret meeting and how on Jekyll Island and then kind of like pitched to Congress, and it was kind of made in secret. Really sketchy stuff, and there was a lot of stuff with the English bank that when they were trying to essentially fund wars and all that. Won't get into that here, but I would recommend the book The Creature of Jekyll Island. Great audiobook, but yeah, that's what I would recommend. But yeah, don't be fooled by the Fed's suit and ties on TV. They are not our friends. Okay, let's go ahead and take a look at, oh wait, one more thing that I want to cover here is, this was one of the dissents by Chicago Fed's Goolsbee. He said that the dissent was rooted in inflation, but we already covered that. What was the other thing here? Oh yeah, so the other thing that came out of the FOMC was this new proposal of buying $40 billion in treasuries. Everybody on Twitter freaked out because they thought it was quantitative easing, but this is not quantitative easing at all. This is essentially just maintaining the level of reserves, right? And so the analogy that I like to picture is a bathtub, right? So think of a bathtub as like the entire financial market and the water level or the water itself being bank reserves, right? Now, pre-2008, they always kept the water level very shallow, and they just lowered and raised it, as needed. But it was typically, pretty shallow, right? After 2008, they flooded the market with bank reserves, and now we entered into a new financial period where now the strategy is, instead of keeping the water reserve level shallow and adjusting that, they make sure that the tub is full, and then they charge banks to use the water. And that's, the Fed funds rate, right? So they're charging banks different rates in order to use the full bathtub. I can do a little bit of a deeper dive on that analogy in a different video or maybe a dedicated video, but essentially what happened is over the past, couple years, the water level was going from super full after the pandemic when they injected $4 trillion dollars, and the water level came down to what's called ample reserves, right? So you see that right here. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities in order to maintain that ample level. What people are thinking about when they think of full-blown quantitative easing, Bitcoin goes crazy, AI stocks go crazy, blah, 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 2021 all over again, that's when something bad happens and which causes reserves to go down to what's called scarce level. And then the Fed has to come in and inject liquidity in order to bring it from scarce back to either abundant or ample. And that's kind of what happened after 2020. But now what happened is we were at abundant over the past since 2023. It's been coming down. And now we're at a point where it's at ample levels and they want to try and maintain it there by essentially letting things continue to roll off their balance sheet, but then they're, instead of just letting it roll off, they're then reinvesting the principal into shorter term Treasury securities, which influences the short end of the yield curve, which is what we'll segue into right now, which is the yield curve signal that we've been seeing. And for those who are unfamiliar, this is our yield curve phase signal indicator in TradingView, which gives you a pretty decent performance curve of, how this is performing on a trending basis, as well as which current phase the yield curve is in, whether that's bull steepening, bull flattening, bear steepening, or bear flattening. We have an entire slide piece in our community where we go over all those different phases. All you have to know for this video, though, is that we are entering into what's called a bear steepening, which is when the long end of the yield curve, which is the bond market's way of pricing in future growth and inflation expectations, is rising faster, or it's rising. And then the short end of the curve is either staying still or not rising fast enough, right? In which case it's actually falling a little bit. And so that's what's causing this so-called bear steepening. And that's why, there's a lot of shifting going on into small caps, as well as financials, cyclicals, industrials, and other things, right? So this is a huge signal here. We really haven't had and you can see it by the orange shading here. Really, the last time we had that was the Santa Claus rally back at the end of 2024. You can see that here, right? So yeah, it's causing the yield curve to bear steepen, which I know it sounds bearish because the name is bear steepen, but it's in terms of bond prices. So bond prices are falling, yields are going up, right? Because people are ditching bonds to go into more of these risk assets. All right. So also too, when taking a look at the correlations right now, which is pretty interesting, when taking a look at the 30-day rolling correlations versus the dollar, you have Bitcoin and oil going, which right now, by the way, the dollar is in bearish trend, right? So things that are getting more positively correlated to the bearish dollar are Bitcoin and oil, which, remember, those are two things that are inflation sensitive, which add to, if both of those are going down with the dollar and growth is starting to reaccelerate, then that could be a signal of slowing inflation. And then we also have the S&P 500 and the 10-year yield getting more negatively correlated to the bearish dollar, which means they're getting more bullish, which is pretty interesting there. We can take a look at a price chart of the dollar, and you can see here, this went bearish in our model back at the beginning of December. You had a little bit of time to get rid of it on this bounce if you had something like UUP, which is the bullish dollar ETF that my team and I use. And, it's had a big drop from here. And so this is a huge confirmation of our bearish signal that we had before this drop happened. And now it's time to pay attention to what things are following the dollar and which things aren't following the dollar. Because if the dollar continues to have a bearish trend downward, those things that are positively correlated trends, you don't want to own those. And right now, that's something like Bitcoin and oil. So that was pretty interesting there. But yeah, when taking a look at the 10-year yield, we talked about how the Fed is buying short-term treasuries. Well, that's essentially when they're buying those short-term treasuries, they are providing demand for those treasuries that the government is issuing to fund their spending, right? And so what happens is if you're restricting or putting like a collar on the short end, and you're leaving the long end of the curve, like the 10-year, to just, kind of just be in the free market. And, people are like, okay, if they're going to do yield control, then I'm going to ditch my bonds and go into more riskier assets. And so it's not surprising that we're seeing a rise in the 10-year yield. And this is the highest it's been since the Fed started cutting again this year in September. So that's pretty interesting and similar to what we saw last September. Yields went up when the Fed cut rates again. So the bond market is rejecting kind of what the Fed is saying in terms of rates. And so that's pretty interesting there. But as you can see, when the Fed had their first rate cut, 50 basis point rate cut in September, on September 17th of this year, we've had it kind of chopped a little bit, and now it's heading higher. Not great news for people who are trying to, get a 30-year fixed mortgage and things like that. But yeah, pretty crazy there. But what's interesting right now is that when taking a look at the 5-year break-even inflation rate, again, similar to how we just, noticed how oil and Bitcoin are still in bearish trend. You also have the 5-year break-evens in bearish trend, even though it's had a little bit of a bounce here. Wouldn't be surprising if it continues down further, which would confirm actually the Fed's target of inflation coming down while growth is remaining steady. You have volatility lower. We're not seeing any type of risks in the credit markets with credit spreads still remaining in bearish trend there. So no crazy type of moves happening in credit risk. I know that this week also too we have the Bank of Japan, the Bank of England, and I think the ECB, the European Central Bank, all doing rate announcements. So we want to pay attention to that, specifically with the Japanese, with the Central Bank of Japan. If those even continue to either hike rates, I think it'll still get the long end of the yields up in the U.S. Yield curve there. So let's go ahead and take a look at some of the biggest movers from last week. Let me go ahead and go back to, let me see, actually, we can take a look at the big one here, silver. Let's bring up the ETF SLV. And this has really been one of the bigger performers of the year so far. Silver. This continues to be one of the biggest trends, and then we're finally seeing a large acceleration last week from things like materials, XLB. That was a pretty big signal, and that's now a bullish trend for the first time in a little bit. Same with financials, so XLF. Look at that breakout. And then also too, this is kind of unrelated to what we were just talking about, but it's well worth noting. I don't know if you guys saw that announcement by Trump talking about how they were going to, sometimes he's all talk, who knows if it's actually true, but they're working on taking cannabis from a Schedule 2 to a Schedule 3 drug. And so when you see something like MSOS, which is the cannabis ETF, look at that move. So cannabis stocks might be back on the table here. And so, obviously this is just a signal. We want to see what happens from here if it's able to maintain this trend and then buy dips if it's able to do that. But that is now something that's on our list. Pot stocks, you remember those from 2018? Pot stocks, cannabis stocks have really just been kind of that's really been the big announcement that it's been waiting for the entire industry, is if it's going to go from a Schedule 2 to a Schedule 3. So if that actually happens, that's going to be huge for that industry. But that was one of the bigger movers last week. In terms of the top MAGA, or not MAGA, top MAG 7 stocks here, Tesla was one of the bigger movers too as well. So that was pretty interesting. Yeah, the best trends, silver as well as energy too. That's one of the ones that's on our list here, and which had a little bit of a buying opportunity on Friday, along with some other things that were also bullish trend. Yeah, worst trends, Bitcoin, utilities. In terms of Mag 7 stocks, not all of them were created equal, and we're seeing this trend shift out of some of these other ones. And yeah, sorry to say for those people who are fans, but Nvidia, bearish trend. Microsoft, bearish trend. Meta, also bearish trend. As well as Amazon is starting to. This is the least bad out of this bunch, but this is also on the verge of. I mean, in my view, it's bearish trend, but this is another one here. And then some of the big ones, some of the worst movers from last week in the Mag 7 were Broadcom, so AVGO. And this is kind of what brought in that AI scare, right? Because that's another narrative that's being challenged right now is all of this AI capital expenditure, all this investment going to actually, produce the result that everyone's betting on, which is this AI, miracle boom. So anything that disrupts that narrative too might have a pretty large effect on, the broader market as well. So Broadcom as well as Oracle, which also is in bearish trend. All right. But again, things like cyclicals, industrials, financials, as well as small caps, IWM. Check that out, new highs. As well as value stocks. All right. Let's see here as well. Yeah, small caps, financials, materials, all are rising trends right now, as well as Walmart, WMT. Take a look at Walmart. This is something where, it had a pretty large breakout. I'd probably wait for this since, when we take a look at the ranges, it's near the top end of the trading range on slowing volume. So that's definitely on the list to buy for our team. But yeah, as you can see, just looking from the charts here, tech also slowing growth, the Mag 7 stocks, MAGS, they don't look the same, right? So those are losing strength. And so that's what we're seeing, right? Now, when it comes to, let me see here. So when it comes to that flip, we really want to start to see if, especially this week, as we get more inflation numbers as well as jobs numbers, you want to see, well, actually for November as well as December, if we take a look at the Cleveland Fed's inflation nowcast, we can see that even in December, it's going to come down slightly to 2.9% from 3.0. But the CPI print on Thursday this week, it has a very high likelihood of maintaining at 3%, which might be a catalyst for some of the hawks on the FOMC, like Goolsbee, to say, see, I told you, inflation isn't coming down yet. Now, I don't know how that will affect the markets because the markets are already front running past this CPI report. So I'm not sure if it'll have too much of a, medium term or long lasting reaction. Maybe you'll get some volatility rising. But yeah, the rotation into small caps and cyclicals, you just can't ignore that. But yeah, I mean, really, that's the confirmation. Just because something has confirmed a trend doesn't mean you have to go out and buy it right away. You want to make sure that you are paying attention to any types of dips on lower volume, On Friday, we did have a pretty decent dip in the S&P 500, still remaining in bullish trend, but as you can see, it was on accelerating volume there, and you can see volume is coming in here. When we take a look at the trading ranges heading into tomorrow, top end of the trading range between 696 and 694, low end of the trading range between 674 and 672. If we continue to have another day or two of red near the low end of the trading range, that's what you would want to see, and then you would want to see possibly volume start to come back down here as it trends closer to the low end of the trading range, which would present a buying opportunity, right? So yeah, good news there still, though, for things that are in bullish trend that might have a little bit of a dip, which we'll be talking about here once we go offline. I know we did go about 10 minutes over that we typically do for our stream here. And so we're going to go ahead and go offline, where we're going to have a discussion on not only what we covered just now, but also with any of the actual ideas that we have on our list. And so, if you want to be part of that, you can go ahead and take a look at the description below. There's a link in there where you can schedule a time. Or for the people on TikTok or Instagram, you can go to the link in my bio there and you can book a time there. But I appreciate everyone for joining. This was the last Sunday macro wrap up for the year. And so I hope everyone has a fantastic and Merry Christmas with their families, as well as a safe New Year. And we will catch you on that first Sunday after the New Year there. So I'll still be doing videos during the week, though. So this is just the last Sunday session, but I'll still be doing lives all next week, as well as the week in between New Year's and Christmas. Just no Sunday macro wrap-ups. But I appreciate everyone for joining. People are on the Zoom call. Hold on, hang tight. Let me just log off and get off the stream here, and we'll continue to the discussion after this. But bye YouTube, bye Instagram, bye TikTok. Have a great week, everyone.